Next case on the docket is Ally Financial versus State Treasurer of the State of Michigan.
Good afternoon. Michael Bowen for the taxpayers, Ally Financial, and Santander Consumer USA. This case has been distilled down to 4 distinct issues for oral argument, and it's tempting to analyze the case by focusing on these 4 points of law. Yet there's a common underlying theme to each of these issues. The department in this case has frustrated legislative intent. Legislative intent of the bad debt statute was to provide relief to retailers and lenders who incur bad debts. The statute has 2 principal functions. Number 1 is to outline specifically what the requirements are for a bad debt claim. And number 2, to delegate authority to the department to verify the accuracy of the deduction. Instead of merely executing their delegated duties, the department has failed to, in this case, to confirm the accuracy of the claim deductions, and it has instead crafted a procedural obstacle course designed to prevent relief under even the most common of lending relationships. The bad debt statute defines a bad debt with 2 sentences. The first, which outlines the starting point for a bad debt, refers to federal law. If you have a bad debt for federal corporate income tax purposes, then you have a bad debt for Michigan sales and use tax purposes. The second sentence outlines 7 specific exclusions that need to adjust the federal bad debt. At issue in this case, a bad debt shall not include repossessed property. This language is unambiguous. The legislative intent is to reduce the principal balance of the debt by the value of the repossessed property. This is consistent with the logic of the preceding 6 exemptions.
Counsel, I just have a quick logistical question. Have all the vehicles been repossessed?
Not all the vehicles in the claim are repossessed, but the ones at issue today are the repossessed vehicles.
Thank you.
So the approach of the prior 6 exclusions is to restrict the recovery for bad debts to the principal balance of the debt in the hands of the claimant. Some of those exceptions are finance charges and interest, for example. If an interest charge or a finance charge accrues on a bad debt, that's not a bad debt itself. That's accrued on the principal balance. Recovery is only allowed for the principal balance of the debt. Similarly, the legislature undeniably intended the dollar value of repossessions on the sale of the repossessed vehicle to reduce the principal balance of the debt. For example, if there's an account balance of $20,000 and the customer is in default and becomes worthless and the vehicle is sold for $5,000 at auction, that $5,000 would reduce the $20,000 principal balance on the account. $15,000 remaining would be the bad debt. There is no question, the department would not dispute. Looking at that objectively, that $15,000, so there's no recourse left to the lender, is a bad debt. This repossession exclusion, as interpreted by the taxpayers, is in harmony with the remainder of the statute. And this is the only reasonable interpretation. The appellate's position, the taxpayer's position in this case, is also supported.
How's it in harmony with the rest of the statute?
When I mean the rest of the exclusions, meaning that the exclusions that precede it.
Your argument from a statutory construction standpoint is that notes that are associates, it's known by the company it keeps. Is that the argument? It's like the other ones on the list?
Correct.
How so? Just give us your best, hum a few bars on how it's like the other ones on the list. That should inform how we think about it.
Sure. Well, subsection 4 of the bad debt statute, which delegates the authority of the department to determine the accuracy, The second sentence, they focus on the first sentence, which is the delegation of authority. The second sentence of that subparagraph states that the goal is to determine the accuracy of the deduction to the principal balance.
Wait, where
Only
is that?
to-
Where is that? Where are you referring to?
Well,
The second sentence of section 4I1,
subsection
4I1A? Definition of bad debt?
4I-4.
You're in the 4 now?
Yep, that's it. The first sentence is delegation of authority, and the second sentence instructs the department as to what the parameters of their authority are to verify the accuracy of the claim deduction. So, to your question, Justice McCormick, when we have the other exemption, other exclusions, finance charges, the finance charge is on the principal balance when we report it to the department, that has to come off the top. We can't
Right.
include that as part of the debt.
That seems clear, yeah.
Interest is the same. It's the same concept. Sales tax, that's not part of the principal balance. You're only allowed to claim a deduction or a relief under the statute for amounts that were actually subject to tax. And then we have the next exemptions relate more to the possession, meaning that, for example, the layaway exemption, meaning if you uncollectible amounts on the purchase price remaining where you actually still have the property in your hand and you never turned it over. And then expenses incurred on trying to collect. That's not part of the principal balance either. You're only allowed to claim the deduction for the actual debt that was financed. Repossession is the same concept in the sense that you have an amount financed, but you've sold the collateral to it. The only thing securing the account, the balance was used in this case to reduce the principal balance of the debt. What's left is the bad debt. There's no question, and again, the department would not dispute objectively that that is a bad debt. There is no further recourse to Ally or Santander to pursue that. So for these reasons, we believe the repossession exception, the only reasonable interpretation is that of the taxpayers. Now, the department has argued for respectful consideration in this case, but yet our position is that you can't grant respectful consideration when there's been no articulated reason for the department's position. Now, the revenue bulletin was the highlight of both the Court of Claims and the Court of Appeals decision itself on admission by the department in this case merely parrots the statute. Their position on brief and the supplemental briefing was that there's nothing there. All we're doing is basically reiterating what the statute already says. So relying on the bulletin doesn't help. So the only aspect of respectful consideration left is that their view of their interpretation that they've always had. But again, before the Court of Claims, Court of Appeals, oral argument, briefing here twice, there's been no rational explanation, reasonable explanation, as to how their interpretation of the repossession exclusion is in harmony with the remainder of the statute. There's no basis for it, and they haven't given one for it. So there's no way to be able to grant respectful consideration to something for which you do not even know what it is that you're going to respectful consideration for. So moving on to the other issues in this case, we have the RD 108 concern, which is proof of sales tax paid. So the statute vests authority in the department to determine what evidence substantiates a claim. This is subsection 4. This same subsection, again, is also clear that the department's job is to ensure the accuracy of the deduction. Here, the department has improperly exercised its authority to raise yet another artificial barrier to recovery. What do I mean by this? The RD 108, as was briefed in this case, is a function of the department's sales tax paid mechanism. The dealer fills out the RD 108, showing sales tax paid on the transaction. It gets sent to the Secretary of State. The Secretary of State takes it and on the department's own form informs the department of the sales tax paid for each certificate of registration and title. As a result, the department is made aware clearly that the sales tax has been paid on these transactions. Now, in this case, the department has asked the lender, Ally and Santander, to present validated RD 108s. That is the RD 108 that's stamped by the Secretary of State, sent back to the dealer, and as asking the lender to actually request those copies from the dealer who has theoretically would have the record-keeping requirement, but is not under the control of the lender, to provide those validated RD 108s as the sole proof that sales tax was paid. This is problematic for a couple of reasons. Number one, it ignores the commercial reality of a third-party lending situation. The lenders have no ability to force the dealers to provide them copies of the RD-108s, the validated stamped copies that come back. And the taxpayer's argument is that the department knows exactly which vehicles sales tax was paid on, because under Michigan law, title cannot be issued unless sales tax is paid by the Secretary of State. It's a shall worded statute. We know that all the vehicles in this case are titled and registered in the state of Michigan. The department does not dispute that. It's logical to assume, at least in this case, with respect to third-party lending, that all sales and use tax was paid on these vehicles. Again, this is problematic because the department has issued basically what's a one-size-fits-all approach. And although that may work when you have self-financing by dealers, it does not work correctly in the third-party lending situation as in this case. The second basis for the RD-108 concern is the fact that the department did not even publicly articulate that the RD-108 was the sole basis for proving sales tax paid until December of 2015. This case involves the debts that were charged off long before then. The record-keeping issue is more problematic as a result because we had to go back to our lenders, not even knowing that the RD-108 was the only basis for proving the claim, and seek the validated RD-108s from them for a period that we didn't even know at the time that we needed to get the validated RD-108s. So for these two reasons, the validated RD-108 requirement must not be upheld in this case. The final issue relates to Ally's written election forms. In this case, the Ally's written elections were prepared expressly to qualify under the bad debt statute. Now, the bad debt statute requires that when you have a third-party lending situation, that the lender and the retailer enter into a joint election, making clear which party is entitled to to seek relief under the bad debt statute. That is exactly what was done in this case. The disputed forms refer directly to the bad debt statute and articulate that Ally is entitled to claim the deduction for bad debts. The dispute in this case is certain of the form language that was used by Ally. And this raises an issue, at least in the department's mind and that of the Court of Appeals, of one of intent. But if the intent wasn't to seek relief under the bad debt statute for the accounts in this case, which is why we produced them in discovery, then I'm not really sure what the intent was. It was clear that that was our intent. Now, that said, the department's position is that you can't have the written election applied to accounts that were charged off prior to the execution of the election form. That is clearly an incorrect statement. And the department should easily acknowledge that. If you have an account and it's charged off for federal income tax purposes, or even if you sought relief under the Michigan bad debt statute, and Michael Bowen makes a payment 5 years later, there's still an account. I still have the ability to collect on that account. I can still seek a judgment, I guess, potentially if that person wins the lottery on that account or something along those lines. So the account exists. It's charged off as a bookkeeping entry for the purposes of claiming both the federal income tax deduction for bad debts and the Michigan deduction for bad debts. So to argue that those accounts don't exist, I think, is a little bit disingenuous.
You're down to 2 minutes and 10 seconds. Do you want to reserve any time for rebuttal?
I reserve the balance of my time. Thank you.
Okay.
Good afternoon. May it please the Court, Assistant Attorney General Emily Zilgett, appearing on behalf of the state in the Ally Financial case. Also appearing is Assistant Attorney General Jessica McGivney, appearing on behalf of the state in the Santander cases. We have Kate Dalzell, Assistant Solicitor General, also at council table. Today I will address the RD-108 and written election issues, and Ms. McGivney will address repossessed property and the applicability of MCL 24.232. And we would like to split our allotted 15 minutes, and we'll keep track of our own time.
Okay.
There are two relevant transactions in these cases. The first is the retail sale and the customer's payment obligation to the lender under the installment contract. The second is the sales tax that is due on the retail sale to the state of Michigan. It is the second transaction that is the subject of these cases, the 6% sales tax due to the state of Michigan on a series of individual sales of motor vehicles, and the lenders in these cases seek a refund of that 6% sales tax. It is by the grace of the legislature that the lenders are able to seek a refund of this sales tax, and for that reason, the statute must be construed in Treasury's favor, and the lenders bear the burden of proving entitlement to the refund. The Court of Appeals did not err in finding that Treasury was within its right to require the lenders to submit validated RD-108 forms, and that the lender in the Ally Financial case failed to submit written elections as required by the bad debt statute. And each of these grounds is an independent basis to affirm the Court of Appeals and deny the lender's application for leave to appeal. Beginning with the RD-108s, this court asked how it should review Treasury's decision to require validated RD-108s, and Treasury submits that the correct standard of review is rational basis, because Treasury was acting within its discretionary authority to administer the statute, and should uphold that decision unless there is no rational basis for it. There was a rational basis for Treasury to require the validated Form RD-108 in this case, and that is to prove sales tax was actually paid to the state of Michigan and in what amount. At the most basic level of any refund request, a taxpayer cannot obtain a refund of tax unless it was actually paid to the state of Michigan first. And if the taxpayer is entitled to a refund, it's only in the amount that was actually paid to the state of Michigan. The RD-108 in this case...
Does the state have those records? Secretary of State?
The Secretary of State does have those records, presumably. The Secretary of State is not a party to this lawsuit. The Secretary of State does not submit them to the Department of Treasury. So this is, the dealership in these cases are the entities that remit tax to the Secretary of State with the application for certificate of title. So that is a Secretary of State form. Sales tax in the context of dealerships is a little different in that tax is remitted to the Secretary of State as opposed to the Department of Treasury.
And what about, and so, you know, I guess the opposing counsel would argue that you have a better ability to obtain those documents since they were conveyed to the state along with the tax money paid that's really at issue in this case, albeit to a different department. And so what about the taxpayer's argument that they don't have control over these documents in these third-party lender situations?
Your Honor, we disagree with that statement for a couple of reasons. First, it's not Treasury's burden of proof to prove the taxpayers.
You already said that, but
well,
we're talking now about control over the documents.
Your Honor, the control over the documents, I think, highlights some of the problematic nature of allowing a third-party lender to obtain a refund in the first place, because the lender is not actually a party to the retail transaction to begin with. So that's between the dealership and the customer, and then it's later assigned to the third party. So if we accept the lender's proposal, it's problematic for a couple of reasons, and one is that it allows the lender to dictate what evidence it determines to be necessary to support its refund request. It also allows them to have absolute control over whatever records they obtain, because they obtain all of them from the dealership in the first place.
So I'm trying to understand this issue of control. The first part of your answer sounded like you agree it's not in their control, but now at the end you said something about they have some ability to determine what records they get from the dealer in the first place?
Well, Your Honor, the RD-108s do originate with they're in the possession of the dealership. It's a receipt. It's something that every taxpayer is required to keep in the state of Michigan under the general sales, or taxpayers who are liable for sales tax. They all must keep receipts under the General Sales Tax Act and under the Revenue Act and under the Motor Vehicle Code. So the lenders, we think, have the ability to get these forms from the dealership in the same way they got the installment contracts from the dealership. I also disagree with the statement Mr. Bowen made earlier that we requested these so much later in 2015. We actually requested these 2 months after the lender submitted their refund request. So the refund request was submitted in August of 2010, and when Treasury responded in October of 2010, it requested the RD 108s to prove that sales tax was due and in what amount on the transactions at issue in this case. Because there's a rational reason to require this documentation, Treasury would ask that the application for leave is denied on that issue. Regarding the written elections, this presents a narrow contract interpretation. We're simply looking at the language of the election agreements in this case. As both the Court of Claims and Court of Appeals ruled, the phrase currently existing as used in the election agreements must be given meaning, given the sheer repetition of its use. It's Treasury's position that the accounts that were written off in 09 and 010 were not currently existing in 2013 and 2014 when the election agreements were executed. That's 3 or 4, maybe even 5 years later, after the debt has already been written off, deemed worthless and uncollectible for federal income tax purposes. Because the contractual language in the election agreement is unambiguous, it's reflective of the party's intent as a matter of law. So we don't need to get into this an intent issue because the language controls. If your honors have no further questions on RD 108s and written elections, then I will conclude and my colleague will address the remaining issues regarding repossessed property and the APA.
Perfect timing, 7.5 minutes left.
Good afternoon, Mr. Chief Justice, and may it please the Court. Assistant Attorney General Jessica McGibney appearing on behalf of the state on the Santander cases. Turning first to the issue of repossessed property, Justice Bernstein, you asked about whether all of the accounts at issue in these consolidated cases address repossessed property, and I can answer your question as to the Santander cases. In the Santander cases, refund requests were made on 1,365 separate accounts, and 1,065 of them included repossessed property. The Court of Appeals did not err in ruling that the lenders are not entitled to deduct the unpaid balance after repossession based on the statutory language. Bad debt is defined, as opposing counsel correctly identified, in 2 sentences in Section 54I1A. The plain language of the bad debt statute excludes all accounts involving repossessed property because repossessed property means the unpaid balance after repossession, not the value of the repossessed property itself, as the lender suggests. The first sentence...
How do we know that?
We know that from the language of the statute, Your Honor, and I would like to explain that to you.
Sure.
So if you look to subsection 1A, that identifies the scope of a potential bad debt deduction. It says that bad debt is any portion of a debt that's related to a retail sale, and the debt has to be eligible to be deducted under IRC 166. That's the federal bad debt deduction. Under IRC 166, the most a business could deduct would be its loss to its business income, and that is because the tax base for a federal deduction is a business loss. So in these cases, the retailer and the customer, they enter into an installment contract. The business keeps its records on an accrual basis. So this installment contract is an accounts receivable, which it reports as business income on its tax returns, and it reports as a credit on its own bookkeeping. So if the time comes when the retail sale, the customer stops paying and the account becomes uncollectible, then a bookkeeping determination is made, and then for the amount of the deficiency, the business can then seek the deduction from its business income on its tax returns. And the reason for that is it never received this money, and therefore it shouldn't be taxed on this money. And I have an example. Assume you have a retail sale for a vehicle for the taxable amount of $10,000. The customer never makes one payment. The vehicle is repossessed and sold for $6,000. That means that there's a $4,000 balance due. That's the debt. That is the amount that the business could deduct under on its federal returns under IRC 166. This is the scope of the potential debt, the $4,000 deficiency. That first sentence of the definition identifies what type of potential debt is in. The second sentence, considering that the only eligible amount to be deducted is the unpaid balance, the second sentence tells us what is limited or excluded from an otherwise allowable deduction. Now, this is important because the 5 items that are excluded may be included in your federal deduction. So items such as interest and sales tax, those are items that could be deducted because those were part of the business income. But the Michigan legislature saw fit to exclude repossessed property. But going back to the first sentence, because the only portion of the debt that could be deductible is the unpaid balance after repossession, this is the exclusion that is from the deduction. Now, the lender suggests to this court that repossessed property means the value of the repossessed property, but that can't be so, because going back to the first sentence, it has to be the amount that could be deducted. Now, the business could never deduct the $10,000, and it would not be deducting the $6,000 recovered because that was business income that it actually received. The only amount that could be deducted would be the $4,000 balance, and that is what is specifically excluded when the legislature said repossessed property.
Should we be impacted by the fact that a bunch of other states who've adopted similar provisions under this sales tax, streamlined sales tax agreement, have reached the opposite conclusion? In fact, it appears the majority of them have, either legislatively or administratively.
Your Honor, I would like to answer your question in 2 parts. The first is that Michigan's bad debt deduction from sales tax was enacted in 1982, and the streamlined provisions were adopted in 2004. There is no uniform bad debt deduction as it relates to streamline. So that's my answer to the portion of your question that deals with uniformity. Treasury would not agree that it was a uniform
But all these other states have very similar provisions. In particular, they all refer to repossessed property in just the same way, do they not?
Your Honor, I do not, Treasury submits that the other states are not relevant for the simple reason that what lenders rely on are not other states' court decisions regarding the language of the statute, but rather other departments of Treasury who are making policy decisions on how to implement their own tax. And I would cite to...
That's confusing to me.
Certainly, Your Honor.
And those other states have issued regulations or promulgated regulations, right, I guess, to interpreting this provision in the way the taxpayers believe we should. And you all, for some reason, we have no promulgating regulations. How should we think about that?
In 2 ways. First, Your Honor, I'd like to address the fact that what you stated is correct. What the lenders rely on are the interpretations of other departments in other states. But I'd also like to point out that Michigan is not the only state that excludes repossessed property.
There's Arkansas.
Ohio does in Arkansas. Michigan's bad debt statute is modeled after Ohio. But I'm sorry, Your Honor, I don't recall the remainder of your question.
It would be helpful if you all had promulgated a regulation that said, we, like Arkansas, we want repossessed property to mean all of it, then we wouldn't be here. This would be a lot easier. But because there is none, for some reason, the department hasn't promulgated regulations. We have to just... How does that cut? Does that cut in your favor or the taxpayers' favor?
Well, Your Honor, I think it cuts in Treasury's favor, and I'd like to explain why. Now, Treasury wasn't required to issue an administrative rule. I see my time has expired. May I answer your question?
Because I cut Justice Viviano off, too, and I bet he has more questions because I see all his papers all over his desk.
Certainly. I will continue. So, Your Honor, there was no requirement in this case for Treasury to go through a formal administrative rule process. That's the fact. Treasury relies on the plain language of the statute, but also issued a revenue administrative bulletin that indicated that was essentially the same as the statute, saying that the unpaid balance is not subject to the bad debt deduction. Now, how does that cut? Judicial review, of course, the intent of the statute should be discerned from the plain language of the statute. If an ambiguity exists, it would be proper to look at Treasury's RAB. RAVs are to be given respectful consideration. Subsection 5 of...
I sort of agree with opposing counsel, though, that the bulletin doesn't analyze the statute, and really the Court of Appeals doesn't analyze the statute, nor did the previous unpublished case that the Court of Appeals cited. So it's almost like we're on a clean slate here, are we not?
Well, Your Honor, Treasury submits that the statute itself, in its first and second sentence of the definition, identifies what the potential deduction could be and what's excluded for it. So Treasury primarily relies on the plain language of the statute.
So we're back to that. Let me ask you this sort of bottom line question that's
Certainly.
been bothering me. Maybe you can help me. Your interpretation, as I understand it, means that the taxpayer, the bottom line is that they'll end up paying sales tax on sales revenues that they never received. That seems like a very striking concept to me. One that I don't, it's hard to imagine the legislature was really drilling down on, trying to collect sales tax for sales revenue that was never received by the taxpayer. First of all, do I have that wrong? Have I gotten to the wrong bottom line, or is that the functional result of your analysis?
Well, Your Honor, I believe the assumption probably is where that there is a loss, and that there is in fact a loss or an unpaid balance. So as it relates to
your example would be the 4,000, right?
Oh, correct, Your Honor. I was just going to say the premise is that there are situations, not in this case, where a repossession could result in a surplus.
We wouldn't be here, right? Everybody would be happy then, except maybe the poor soul who wasn't able to pay for their lease or their loan. But
Your Honor, I guess the best way I can answer your question is that the fact that the deduction exists at all is a matter of legislative grace, and we see that by the words that the legislature used. If the legislature wanted a deduction for repossessed property, it would not have specifically excluded it. And I would turn to 2 instances within those 5 exceptions.
What possible rationale would the legislature have for excluding repossessions? What would be the idea? They want to disincentivize repossessing personal property that's not paid for so that consumers could just keep the property? You think that's what they were trying to do?
Your Honor, I'd like to answer your question in 2 ways. The first is I'd like to point
A lot
out...
of multi-part answers, but go ahead. I'm just trying to track them.
Okay. 2 things, Your Honor. If you look at the 5 specific exclusions, you have repossessed property and you have layaway. So there's 2 transactions where the retailer or lender in this case never loses its property. In preparing for arguments today, we conducted research about what the public policy was behind this deduction. And we learned that it was that a retailer, the issue that was identified was that a retailer should not have to pay sales tax on a transaction where a customer defaults on payments and keeps the property. So essentially you have a situation where the customer has in effect stolen the property and has never paid the retailer. And then the retailer still has to pay tax on the transaction that never occurred. And this is not the case with repossessed property. So, Your Honor, I would submit to you that the distinction would be is that the retailer and the lender in this case retains or never loses the property in the first place.
So even though they let the person drive off the lot with the car and the car gets a bunch of miles and other wear and tear on it, when they get it back, they got exactly what they sold?
Well, Your Honor,
That's your position?
the deduction...
I mean, the layaway, you put it on, buy my sweater and it's on layaway and I don't pay for it, you could have a pretty good argument there that the sweater and the bag or whatever it's in is in the same condition it was on the date of sale. But
certainly, and there'd be different treatment for that kind. That would be a return and there would be a full refund of the sales price. But the legislature just articulated different treatment as it relates to repossessed property. As it relates to the concept of fairness, I mean, a deduction from the sales
I'm not
tax...
trying to do fairness, but I'm trying to figure out what the legislature was trying to get at, what they intended with the words that they chose. And I'm just trying to think of what would be their intention as it relates to repossessed property. Why would they intend the statute to mean what you say it does? But that's not the focus of my inquiry. Either is the bottom line focus, by the way. Those are just curiosities as to why you think the statute should be interpreted in a way that would mean that taxpayers would have to pay taxes, sales tax on sales revenue that they never received.
No, Your Honor, there could be any number of reasons why the state would not want to look behind a repossessed transaction. You have the different valuations, and it was perhaps
But every
easier
other
to-
state, or most of them, has figured out how to do this accounting. Are we just not that good at that in Michigan? I mean, the federal government has a whole part of the IRS code dedicated to this cost basis and what you do to figure these things out, realize the amount and less the cost, all these different calculations.
It appears, Your Honor, that this was just a line that the legislature was not willing to go beyond. And, you know, it was a business decision for these lenders to seek repossession, and there are tax consequences to each and every business decision, Your Honor.
So you think the legislature was disincentivizing repossession?
That could be true, Your Honor.
Okay.
Thank you.
If there are no other questions, thank you. The state would ask that the court deny the application. Thank you.
The questions of the court to opposing counsel are well taken. If these transactions we're referring to today with third-party lenders are so problematic, you would think that in the last 10 to 15 years, the department would have issued something other than a bulletin that is not entitled to respectful consideration and only parrots the statute. The Streamlined Sales and Use Tax Agreement, of which Michigan...
Why isn't the statute good enough, though?
The statutory language isn't good enough in itself to support the department's position because the exclusion is meant, again, our interpretation, given the harmony with the rest of the exclusions in the statute, is it's only to apply to the value of the repossession. That makes sense because the legislative intent behind the bad debt statute was to be able to refund sales tax that was never actually paid on the underlying transaction, which is what occurred in this circumstance. If you sell the repossession for substantially less, which is always the case, than the account balance, then you have a bad debt. There's no dispute that the balance that's left is a bad debt. There is no recourse remaining. And as a result, the statutory language can only be interpreted to mean that once the repossessed property has been sold, you reduce the value of the principal balance subject to the bad debt deduction. So the fact that nothing has been issued other than a bulletin, again, and we're here on 4 separate issues, 4 separate obstacles, 4 separate artificial barriers to a common lending situation in which a bad debt is most clearly recognized. And yet we're here today before the Supreme Court still unable to get sales and use tax refunds on amounts that are undoubtedly bad debts and undoubtedly within the legislative intent to grant relief. Again, the Streamlined Sales and Use Tax Agreement is important in this case because there is no guidance from the department. There is no decision on point that provides any analysis regarding what the repossessed property exclusion means. That said, the Departments of Revenue of at least 6 other states that we've cited on brief unilaterally agree as to the definition of what repossessed property means.
Who's right about Ohio, you or her? You guys both claim Ohio.
Our citation to Ohio in the brief is directly on point. It's their own administrative code. And I disagree that Arkansas stands for the position the department says it stands for. There's been no interpretation of it in the courts, much less I've never seen any discussion of it in which they've interpreted it consistently. So again, the Streamlined Sales and Use Tax Agreement was the reason why that came to be, and this is probably a foreign concept to the court.
Our statute predated the agreement?
It did.
How is it that all these statutes are the same if they didn't flow from that agreement?
Perhaps the Streamlined Sales and Use Tax Agreement adopted the language from other model, that pulled it from, because how that forms in Justice Viviano, I'm not sure if you're familiar with the process, but the Streamlined Sales and Use Tax Agreement is formed by effectively a committee, which is all the departments of revenue come together, policymakers, and they determine what this model agreement should read. And the reason why they have a model agreement, as you might guess, is so that when you have multi-state businesses, there's predictability amongst all the sales and use tax laws of all the states. And in this case, Michigan, at least in the taxpayer's view, stands on an island with no guidance other than the statute, and everyone on the other side interpreting it consistent with how the taxpayers have interpreted it in this case.
Any other questions? Okay, your case will be submitted. Thank you.